Welcome to the daily update, where I'll go over the action in the market for Monday, April 14th, and we'll see how things look for Tuesday, April 15th. Seems like the market is trying to stabilize. We'll see if it can stay that way. It's been really crazy. Last week was just nuts. Well, at least on Monday, things seemed a little more orderly, and we'll see if there's some kind of news that hits about the tariffs or the reaction to it or some kind of an event that causes the markets to gyrate more. But in the meantime, it does look like things are getting a little bit calmer right now. So, right at the open, we did have a gap higher and we gapped above R1 at 54.23, but that was pretty much about it. We saw the high set earlier in the day, and R1 was at 54.23. And then, which is very common, we saw a counter move to that. We came all the way back down to the unchanged level, which then acted as support. That's a built-in support or resistance level. And we were able to get back up to R1. And then by the close, we drifted down just a little bit to close slightly below R1. So we were up 0.79%, but volume dropped off. That probably is why things calmed down a little bit there. We are still negative in the short and intermediate term. We're continuing to be mixed in the long term because we're watching the 50 period moving average coming down and getting closer to the 200 period moving average on the S&P 500. No real changes about inflation. We had CPI and PPI come out last week, and they were more market friendly. Interest rates did decline. They've been all over the place. We saw that half a point move in just 1 week last week. Well, they're coming back down a little bit too. And there's a little bit of ease, at least right now, as it applies to the tariff situation. Okay, so there is that relief that I just mentioned. A statement came out saying that smartphones, laptops, semiconductors, solar cells, and other electronic items will be exempt from the 10% global tariff and the 125% tariff on imports from China. So the market seemed to like that. Other imports from China are still subject to the 20% fentanyl-related tariff. Then Commerce Secretary Lutnick came out and clarified that the exemptions will be temporary and that President Trump might announce some kind of a rate on semiconductors. So the market seemed to take that more in stride. Instead of freaking out, at least from a market perspective, they just kind of went, okay, maybe we're seeing some adjustments going on here. Now the VIX is coming down, but it's still high. It's still above 30 at 30.89, but it has been inching its way lower. We need to get back under 20 before we're seeing things more positive when we look at the VIX. Parabolic SAR has turned negative. That's a primary, excuse me, positive. That is a primary indicator that we use. And so that's showing that there are some improvements that are taking place. But we've had recent death crosses. This is when the 50 period moving average goes below the 200 period moving average. And the NASDAQ is there. Now we've got a new member on the list, the NASDAQ 100. That just happened on Monday. The small caps and mid caps, which have been there for a while, also the micro caps, the really small stocks, and the Wilshire 5000. That's another broad market measure. And then when we're looking at what indicators are still extreme negative, mainly these are momentum oscillators. Even though they're improving, we still have the slope oscillator that's giving an extreme negative reading and the MACD as well. We have two indicators that are actually extreme positive. The Stochk RSI, which that happened after Friday, and also on this list is the rate of change going back 5 periods because we've seen a pretty good bounce up over the last few sessions. Intermediate term, we're still looking extreme negative with the TTM squeeze, the rate of change intermediate term, which is based on 50 periods, the PMO, and then some of the studies that go with that. A lot of the momentum oscillators are really negative and they're trying to improve, but they're still extreme negative. And that also includes the Copic curve. And we're still far away from the 50 period moving average. That's what the boom indicator measures, how far we get above or below that 50 period moving average. And we're not extreme with the 200 period simple moving average, but we still are in the shorter term 150 period moving average. No changes to the overall scenario as it concerns the Fed. They're afraid that employment's going to go down and inflation's going to go up. And the dollar is declining. It's still below 100. It's continuing to fall, but interest rates did decline as well. We closed at 4.36, where after Friday we were at 4.49% there. So quite a significant drop with the 10-year yield. We're still extreme negative with sentiment. We're below that 25 level, but we are inching our way back up to 19, where after Friday we were at 13. And we're still negative with the trend. It's now starting to weaken. Things are slowing down a little bit, and the ADX is rolling over and starting to go below its moving average. That doesn't mean the trend is changing or it's stopping. It just means it might be getting weaker right now. We are still in a trending environment because we're above 20. And then with the update, the bias is positive. And I've changed the momentum mixed to negative. We still have a lot of damage that was done, but we are seeing some improvements. So that's going from just straight negative over to mixed to negative. All right, we didn't have any economic reports in Monday's session. There'll be some that are released on Tuesday, so there's no charts to show you there. This is coming out when the market gets under pressure, they really start dealing with valuations, and we use the PE ratio. That's the most popular one. And I go through that more in depth with the intermarket analysis video over the weekend. But we're coming in under 20 now. Now we use a 10, 15, 20 point scale or numbered scale there. And when we're at 20 or above, that's considered to be expensive. From 11 to 19 is more fairly priced. 10 or below is considered inexpensive or cheap. So the S&P itself is at 19, but we still have some of these areas such as discretionary, tech, staples, which have been strong lately. That's more the defensive posture that the market's been making, and industrials. They're all above 20, and then the rest of the other sectors that make up the S&P, they're actually below the current PE ratio for the S&P 500. All right, then gold. Of course, last week gold really did well with all the craziness that was going on. And so the forecasts are coming out saying, oh, it's going to the moon and beyond. We'll see if that ends up settling down. But it's just like everything. When the stock market goes up, the predictions are that it's going to keep going up. And when it goes down, it's going to keep going down. It's just how these things tend to come out. Then looking at discretionary equity positioning, this is when folks have their discretion. This isn't the discretionary sector, but it means that they try to pay attention more to what the market is doing. And if things get really negative, they get out. If they get positive, they get back in. That's opposed to a systematic approach where you just use your system no matter what's going on with the overall market. But we're seeing this really coming down right now as folks have been more negative, but they're not necessarily extreme. They're not down to this minus 1.5% area here with the standard deviation. And then I was talking about this off and on last week, and especially when the market was closed, but this could also impact when the market's open. The futures trade all the time. And then when we're in the cash session, when the market's open, we were seeing the bid-ask spreads show get really wide. Now we want them to be close together. The bid and ask price, that's the price that you're going to pay if you buy or the price you're going to get if you sell. And if there's a really wide spread between them, it can really work to your disadvantage. That's one reason I really like the S&P 500. The bid and the ask tend to be close together because it has more volume. Liquidity is a lot higher with the S&P 500, and so you get more fairly executed um, trades when you're getting in or you're getting out. But this was just showing that the bid-ask spread was getting very high, and that was making for these really large swings that we would see, not only during market hours, but also after hours. A couple of trades would take place and we would be down 0.5%. If somebody was selling, somebody might come in and buy and suddenly we're up 1%. And that just makes it really volatile at that point. Then the risk appetite indicator, you can imagine we're dropping below this -1 level here because people are nervous about the market. So we're seeing them be more risk averse right now. The index return of cyclicals, these tend to follow more what's going on with the economy versus defensives. They tend to hold up better, even if the economy's getting worse, because think of toilet paper and toothpaste. And this has really been coming down, but we have been seeing a bit of a bounce up. So this is as the market's trying to figure out what's going to happen with the economy. What's going to happen? Are defensive areas a better place to be? As we've been seeing over the last couple of months, the market's shifting over into a more defensive stance rather than being in a growth type stance. That's when the economy's doing well and they're expecting the big companies like Microsoft, Nvidia to really keep going up and to pull the indexes higher. That's really been coming down lately and wearing off as the market's trying to figure out where do we go from here as far as the economy. Found a couple of interesting charts. This wasn't actually on Twitter or X, but there's been a lot of talk, and I was even mentioning it in videos last week and over the weekend that there's speculation that China, which holds between 7 and 800 billion dollars of U.S. treasuries, that's one way they could get back at the U.S. is by selling those treasuries, because if you sell, that pushes interest rates up since price is going down. And you can see that there has been a trailing off. Now, this goes back a long time. This is 25 years almost of a chart, but you can see where it has been coming down here. We're not necessarily seeing any real spikes to the downside at this point. It's more of a gradual trailing off. We won't really know this until some point in the future to see if that is what has been making interest rates going back up. There's also speculation out there that a hedge fund, it could be anywhere, but the one I heard about is in Japan, that they got caught on the wrong side of the interest rate trade and they were having to bail all kinds of US treasuries, and that could have been pushing interest rates up too. Again, it's pure speculation, but by the time we find out what was really going on, it's not relevant to us. We need to try to figure out what's happening right now. And then down the road, we can try to put the pieces together and actually figure out, okay, this is what was actually happening. Because we look at the charts, and if they're really looking kind of scary, we have to make note of that, and where we may not understand exactly why that is happening. Then U.S. manufacturing is more reliant on China than vice versa. Okay. We get a lot of stuff from China where we don't necessarily sell them a lot of stuff. We do, but it's really not equal to each other here. This is the U.S. reliance on China, and it's pretty high here. Where how much does China rely on the U.S.? It's a lot less. And that's kind of what you've likely been hearing about. And more strategists see the S&P 500 rebounding by year end here. These are just the different forecasts and all the different companies that come out and make their different statements and where they go within the targets. And so yeah, I don't know. People love this stuff. They like it when they make forecasts and things like that. I don't tend to do that myself. I just follow things day by day and just say, okay, this is where we're at right now. Then worse net earnings revisions, we are seeing that, and I've been mentioning this as well, where earnings are still positive. Just over the weekend, FactSet thinks that we're going to have 10% earnings when earnings season is starting now. And but they're not as robust as they were before. They're still going to be 10%. And that's pretty good, but not as good as it was in the past. And we're seeing those revisions really coming down now. And that has an impact on stock prices because the stock market looks at not what the earnings were and not necessarily what they even are right now, but what are they going to be in the future? And if the projections are that they're going to be positive, then that justifies the stock price going up. If those forecasts into the future aren't as good, then that can pressure the stock price itself. Then median and 1 and 3 year ahead expected inflation rate. So 1 year ahead, they do expect inflation, according to this. This is put out by the Federal Reserve in New York. They do expect inflation to go back up over 3.5%, but then they see it tapering off over 3 years. So shorter term, an increase in inflation, but longer term, not as much. And then I don't know how reliable these are. I've showed these in the past, and I haven't found them to be all that accurate. But these are commodity trading advisors positioning. And based on whatever scenarios happen, how much buying or selling are they going to do? Well, according to this, over the next week, if we're flat, they're going to buy. If we're up, they're going to buy. If we're down, they're going to buy. But if we're up, they're going to buy more. And then over the next month, they also plan on doing buying as well. Again, I don't know really how useful this is, but it's kind of interesting to look at. So we did have most of the gains were set right at the open, where we had the gap higher above R1, and then we just kind of drifted. There wasn't the usual gyration that we see as volume did drop off because you got a lot of people that are gun shy now. They were trying to play the market the last week with all these wild swings going up and down. So we just kind of drifted, and then we came all the way back down to the unchanged level, bounced off of that, and then we're able to work our way back up above R1. And then a little bit of drifting going into the close. So we did close off of the high, but it was still an up day and pretty much unchanged. I checked the futures right before I started recording, which it's 8 or 9 hours before the market's getting set to open. So didn't see much of a change here with the initial session that opened Sunday evening, but then Europe opened up, and that's when we started to see things turn positive because Europe had a pretty good day. But not much of a change, at least initially going into Tuesday's session. And we are seeing some general improvements here with both the blue line and the red line going up. We need to see the blue line overtake the red line and actually outperform. That would show that growth is outperforming value. But right now, it's kind of positive just to see at least the blue line for the most part is going up. And value had a better day on Monday than growth, but still, this is showing some improvement here. Not really seeing much of an improvement with S&P growth to value here with the intraday chart. It was starting to really go back up, but now we're beginning to drift sideways. We need to see more follow through with this chart. So end of day growth was up, but up about half of what value was, and it was up less for the mid caps and less for the small caps. So a little bit of an improvement here with the small cap growth to value ratio. We'd spent a lot of time under the 200-day moving average. So it's improving, but small caps still have just been getting hammered lately, and they're in a downtrend now. Not much of an improvement here with the mid cap growth to value in between the 50 period and 200 period moving average. And now with this ratio, not necessarily the end of the world, but still it could be a lot more positive. The S&P growth to value ratio has now generated a death cross, and we spent quite a bit of time, pretty much all of March and so far into April, below the 200-day moving average with this ratio and still a little bit better, but not all that great when we look at the growth to value ratio with these two ETFs. And discretionary to staples, also not really showing any strength currently. And these ratios, if they're going up, that's when the market's going up. And that's when we see the index is doing better. It's still showing that the market is becoming more defensive, getting ready to go down possibly. We are rolling over with the ADX, the black line. This measures the condition of our trend. It's rolling over and starting to drop below the moving average. We're still trending. It just means it's not as strong a trend as what had been happening that led up to the ADX actually climbing. We're seeing a little bit of improvement here, but we're still negative because the red line is above the green line, but the red line's coming down as the green line's going up. And in the short term, we're crossing back down below 40. That's when we really take note of this. That's when any of these lines, the red line, the green line, the ADX itself, when any of them get above 40, that's when it's looking extreme. Like maybe we're getting overdone here and we're looking for things to at least slow down. And that appears to be what's happening currently, or we're coming down with the ADX, still negative because the red line is above the green line. Volume did drop to below average. You can see that here on the next chart, but it has been really robust was robust last week. Sentiment, this is the weekly gauge that we look at, still coming in more negative at 28.8. where we're still extreme negative with the fear gauge that I use, but this is more of a composite with different fear gauges together. We're getting more bullish now with the insider transaction ratio. This is legal insider buying or selling, and that could give the market some help here. But we're not really seeing much of an improvement with the insider buying ETF. We're actually in a downtrend with this now. Then another sentiment gauge, the euphoria meter, which looks at the forward PE, the VIX, and bullish sentiment. It's been coming down, but not necessarily extreme like some of the other sentiment indicators that we follow. The Ulcer Index coming down a little bit, but still giving a very high reading. This is a sentiment gauge that we follow daily. We are dropping with the VIX, but we're still in the 30 range. And we need to get back down to below 20 to be more positive. Still showing that there's heightened fear. And as the VIX is coming down, the VIX of the VIX has also been declining. And the momentum is still up, but we are rolling over with the MACD as the VIX has been coming down. And coming down a little bit with these other sentiment gauges that we follow, after really spiking up, we're seeing a little bit of gyration happening here and a little bit of gyration with this other fear gauge that we follow. So we're seeing a decrease in fear. Still elevated, but not as intense as it had been last week. Looking at the 10-day average of the highs and lows for the S&P, this is a longer term internal measure. This is still looking negative, but it did bounce up a little bit in the latest reading. So slight improvement there, but we're below 50, so it's negative. And then we look at a broad market measure of the 5-day moving average of the highs and lows, improving, but we're coming back up to this red line. That's when we tend to get extreme. So this is improving, and this could be positive if we can see more follow through to the upside here on a broader market base. And the equity put call ratio really shot up. So somebody's really kind of fearful about something on the daily chart. We're ticking back up with the 5-day chart, and we're also ticking up with the 10-day chart, but not really changing all that much. Still showing here that the volatility risk premium is low, and so not a lot of fears being anticipated according to this particular chart. We're still seeing a mixed picture with the advanced decline line. We're above the moving average based on price. Even though we're improving, we're below the line based on volume. And we are seeing slight improvements here, but we're still below zero with the 10-day advancers decliners. And this is used like an oscillator to give us an extreme positive or negative reading. It's improving, but still negative. And we are improving here with the new highs, new lows, another internal measure that we look at. We're really seeing a contraction of the new lows. You can actually see a little bit of green here. There was a few new highs that were set. So we're starting to turn up, but haven't quite crossed with our 5-day, and we're starting to be flat here with our 10-day moving average. And seeing a little more positive, the blue line, that's the short-term advanced decline ratio, is going back above zero. Not quite there yet with the red line, but also improving. And the smart money indicator number one, we are above the moving average here. So that's positive, and the moving average is starting to turn back up. And we're still positive here, even though we declined a little bit with the histogram. The red line for the Chaikin money flow, which is smart money indicator number two, continues to be positive, and we're above the midpoint and going up with the Chaikin oscillator. This is smart money indicator number three. So our three smart money indicators are positive. We're still negative though with the vortex, and we're still below the moving averages with all of our different advanced decline line studies across all the different indexes. Now this is a different moving average than what I just showed, but we're coming right back up to the moving average with the S&P. So it's actually holding up a little bit better. And seeing a bit of an improvement here with those stocks inside the S&P above their 20-period moving average after getting really extreme negative. We are seeing this bouncing back up, seeing an improvement with the 50-period moving average study, 100-period moving average study, and the 200-period moving average study. And incidentally, there's somebody I subscribe to their newsletter, Bob Kendall, if you know who he is. I watch his videos when he's on there. He thinks this is all nonsense. Well, I disagree. So even though I respect him and I like to listen to what he has to say, I use oscillators that he doesn't use. I use studies that he doesn't use. He's got a few years on me as far as experience in the market, but it seems like we're constantly coming to the same conclusion with what's happening in the market, even though he uses one approach and I use a different approach. I don't think what he does is nonsense, but I don't implement it. But he would think what I would do is nonsense, and he doesn't implement it. So it's just different strokes for different folks. As long as you can come to a good conclusion about what's actually happening and be right about it. All right. Anyway, I just thought of that as I was going through those charts because he referred to those specific kinds of charts as being useless. Well, I don't find them useless at all. I find them very helpful. This is what we're concerned about, though. We're seeing the blue line, which is the 50-period moving average, starting to come down and could be getting ready to cross below the 200-day moving average. That would shift the trend negative. And down at the bottom, we were well below average with volume here. But we did see an improvement with the 20, 50, and 200 period moving average studies on the S&P. We're extreme positive with the Stochar RSI. So it's picking up this upward momentum that we're seeing here and it likes that, and it's suggesting that that's positive. Well, the Williams percent R is above the midpoint and improving, but not extreme yet. We are getting close to the midpoint with the CCI 14, and we're a little bit further below the midpoint, but improving with the CCI 20. We're above the midpoint with the short-term stochastic, coming up slightly above the midpoint with the intermediate term, improving, but still below the midpoint here with the long short-term stochastic. And the reason I say that is this is a further subdivision of the short-term time frame. We are positive and showing some improvement with the force index. We're seeing some improvement here with the short-term trend. I use a double and triple exponential moving average and then follow these lines, and they're trying to stabilize a little bit. And if we can stay above these lines, they'll actually start to turn back up. And we're actually seeing the 20 period moving average, the exponential, that was the overhead resistance that we hit. So this moving average has come down so far. We're still far away from the 50 and the 100, but the 20s move faster, and we're actually starting to deal with these moving averages again. Now, if we actually get above this and close above this, then the short-term trend is going to turn back to positive. That's what I use to determine whether we're positive or negative. And we were extreme negative with the rate of change going back over the last 5 periods. Now, for the last few sessions anyway, we are extreme positive. We're seeing some improvement here with our standard deviations chart. After all that damage was done, we're coming right back up to the midpoint, roughly. We're below it now, but the intraday bar came right up to the midpoint. And this is a different take on inflation. It's called trueflation. I've been using this. I started about a week ago, and it has inflation coming in at 1.49%, which is underneath the Fed target rate. So I'm just following this for a while to see, okay, is this something that is actually a good source of information? Intermediate term, we're still declining with the balance of powers. That's kind of strange to have an up day and to have this declining. It's picking out some weakness in the market. We're still more neutral but negative with the go no go. The dark purple, deep purple, that's when it's really negative. When it switches over to the light purple, then that's at least improving, but still negative nonetheless. Also, with the highest high, lowest low value chart, we also came right back up to the midpoint. The midpoint for this chart and the standard deviations chart are the same settings. So that's why the midpoints are the same. But we'll see. Is this midpoint actually acting as some kind of resistance? If we can get back above the midpoint, that would tilt the bias more positive. And we're still extreme negative, but improving with the TTM squeeze. For 2 days now, we've had the lighter shade of red, but we're still below this black line. And we're still extreme with the rate of change going back 50 periods, which is more intermediate term. We haven't been able to break above this pink line, which is the extreme negative line. Coming down, slowing down a little bit here with standard deviation. This measures speed, not direction. And we are improving, but still negative with the ease of movement. Also improving, but negative with the Arun, as the sellers are still outnumbering the buyers, according to this. And looking at the condition of the intermediate term trend based on 50 periods, coming back up here, and the lines are still going down. So that is still determining that the intermediate term trend is negative. And then we're still below all the moving averages here, but we're hitting the underside of the 20 period simple moving average. We need to get back up and try to break through some of these moving averages if we're going to be able to turn back more positive. And we're not far away from the 20 period moving average, but we're still far away from the 50 period moving average. And that's what the boom indicator measures, that we need to work some of this off and get closer to the moving average based on price. And we are turning positive with the S&P McClellan oscillator. We crossed above zero, so we're starting to turn back up with the summation index based on price and volume. And we're just barely above zero with the NYSE McClellan oscillator, so that's turning positive. Can't really see it here in the chart, but we are ticking up just a little bit with the summation index based on price and volume for the NYSE. The Swelling Trading Oscillator, which turned positive after Friday, we're starting to cross above the midpoint based on price. We are coming up, but still below the midpoint based on volume. Momentum, which is still extreme negative, is trying to turn back up here. Still negative, but improving based on price and volume with the PMO. And we're actually seeing some strength here with the PMOs that are rising. This is showing some real improvement. We're just on the border of being extreme negative with the buy signals, but they're improving, and we're rounding out here with the PMOs that are above zero. And we've gone from neutral to positive with the Elder's Impulse system for the S&P, and this is the change. You can see the dot down here, the parabolic SAR. We now have a dot underneath, and so that has turned to positive. And we're still extreme negative with the slope oscillator, but it's trying to turn up, but it hasn't even crossed its moving average yet. The MACD is closer to its moving average after being extreme negative. So it's improving, but not positive yet. So we see the slope actually improving, but the TSI, the other short-term oscillator, it's already turned positive. Where we're seeing some improvements in the intermediate term, we're still negative with our long-term oscillators. The Copic curve still extreme negative, trying to stabilize here, but still negative. And the longer term look at that. And the reason I bring this up is we were getting very low readings with this back in 2022, and that's when we were in the cyclical bear market. So, and we were able to bounce up from this more negative environment. We'll see if that can end up happening this time. And we're no longer extreme negative and showing some improvement with the Sean trend meter. We're still below 50 with the money flow, but we're just barely crossing above 50 with the ultimate oscillator. So that's improving there. We're improving, but still below the moving average with on-balance volume. We're still below 50 with the intermediate term RSI based on 14 periods and the short-term RSI based on 9 periods. We're positive here because we've been bouncing up with the bullish percent index after being very extreme negative. And we're above the moving average and we're showing some strength. Even though we're still below 50, this is showing a real improvement. And we are improving here with the NYSE bullish percent index, and we're actually getting further above this 30 level with the NASDAQ 100 bullish percent index. So there are some improvements that are happening. And we're working off of one mass index signal, suggesting that we could see a reversal to the upside. But in the meantime, a second signal might be getting ready to fire off here. So we'll see how that goes. We are coming up to the underside of the mini rainbow as far as providing overhead resistance. We're not really dealing with any of these lines. This is a 20 period simple moving average of the open, high, low, close, which creates its own little rainbow. And sometimes they act as support if we're going up and dropping back. In this instance, they would be acting as resistance, but not really hitting any of those areas. Now, this is positive because this is a longer term chart going from the October 2022 low to the February 2025 high. We came down to this 50% retracement level, and so far that has held. We were able to recapture the 38.2% retracement level. And so this is positive that longer term support for right now is holding. We're also seeing longer term support here with the weekly chart of the S&P. We were able to recapture this S1 level and we're still above that. It will be even more positive if we could get back up and recapture this P, which is the pivot level. And these lines, they last for the whole quarter. And we're also above the midpoint with the trend channel going back to 2009. So that we saw a real coming together of long-term support. The market came down and tested that, and so far it's been holding above those support levels. And we're seeing that here with the trend line going from the low set in October 2022 and 2023. We came down to this point and so far are bouncing off of that. This is a concern though, because we're looking at the ratio between the SPY, which is the ETF for the S&P, and the staples, which are more defensive. This is what the market gets into when they think it's going to go down. That's what we saw right at the end of 2021. And then the S&P set its all-time high in early 2022, but this was already starting to come down before we set the high with the index. Well, are we seeing a very similar thing here? The high with this ratio was set in January. We set the all-time high in February with the S&P. So now we're starting to see some more weakness here. Is that foretelling that things could get worse? We need to see this ratio start to improve to not have this be as much of a concern. And we're showing some improvement here with the hike in ASHI. This is another way of measuring the trend, and that's positive with the open candles. We're negative, excuse me, we're negative but pointing up with the red line with the Kagi chart. We're still negative with the Renko chart, and we're turning positive again with the three-line break. So, excuse me, gotta love these take one videos. I do everything take one. I just hit the button and start talking, and then that means I cough and trip over my words. But we are seeing a bit of a mixed picture when it comes to the trend using our variation of measuring the trend using different kinds of charts. And we had a couple of new X's drawn in with the point and figure chart. That's positive. There's no signal being generated right now, but this is positive that we're recapturing some of this lost territory. Long term, we're still barely extreme here with the 150 period moving average, but we're not extreme with the 200. And this is a little different way. Stockcharts.com, they updated, they have a new page. It's actually kind of useful, and I might be incorporating some of that in the videos. But this is a little different way of just showing the short, intermediate, and long term for the S&P, the mid caps, small caps, and NASDAQ 100. We're negative in the short and intermediate term, where mid caps and small caps continue to be negative in the long term. And then we look at stocks and bonds, which bonds are now negative across the board. Commodities are negative in the short and intermediate term. The dollar is negative on all time frames. And we had all the different sectors positive. Now, real estate, it liked that interest rates went down on Monday, so it saw some love there. Utilities, another defensive area. You could make a case that utilities are growth because of the electric vehicles and AI and all the electricity that's going to be needed. But typically, it's been more of a defensive area and staples. See, this isn't necessarily positive. We see real estate, utility staples, and healthcare. These are more or less defensive areas, and they're the ones that did the best in Monday's session. So we're not switching back over to a growth outperforming value, at least yet, where the areas that underperformed were tech, communication, and discretionary. Those are the growth areas, and they're actually not doing as well right now, even though they were up. And these are all the alerts that were triggered, most of them positive. We did have a bearish 50-20 weekly crossover, and I showed that in the weekly video. We're looking negative here with the longer term moving averages. And we're just watching that. That means that the trend is starting to turn over to negative. Everything else here was positive except the Nasdaq ended up dropping below 16,700. But most of these are just the Nasdaq going above certain levels. We are seeing some improvements with the BPI with communication, discretionary going above 20. Staples had a bullish MACD crossover. Financials back above 20. See, a lot of damage was done over the last couple of weeks, and the market's trying to repair some of that. But then we also have some of the other defensive areas that are also improving. And financials had a BPI cross back above 30 after being more extreme negative. The Dow is still hanging on to an uptrend, but we're still below both the moving averages here, and that could lead to a death cross. And we've gone from neutral to positive with the diamonds. We are already in a downtrend now with the NASDAQ. And we are still positive, though, with the Elder's Impulse system for the NASDAQ. And we're starting to see a death cross here with the NASDAQ 100. So that's turning longer term negative. But we are positive in the short term with the Elder's Impulse system since it had an up day. The momentum is starting to cross back over to positive. So that's showing some improvement there. We are negative with the small caps, the S&P 600. We're also negative with the Russell 2000. And we're still neutral with the Elders Impulse system for the small caps. We're also negative with the mid caps, and we are still neutral with the mid caps with the Elders Impulse system. The Wilshire 5000, a broad market measure, that's starting to turn negative, and we're getting really close to a death cross here with the total US stock ETF. FANG index, a little further to go to generate a death cross, but still hanging out below its 200-day moving average. The financial sector, we want this to be strong if we're more positive, not only on the market, but the economy. It's been holding up and able to get back above its 200-day moving average and has a little more of an established uptrend. Apple ended up being up 2.21%, but it's in a downtrend now, and Amazon below its 200-day moving average and seeing a threat to going into a downtrend. Microsoft has been in a downtrend for a while, coming back up to its 50-day moving average. Google is also in a downtrend, but up over 1%. Meta, another one of the better looking charts here with as far as the trend is concerned, but it's still below its 200-day moving average. And Tesla is just about getting ready to generate a death cross here. Nvidia is in a downtrend and was virtually unchanged on the day. Netflix, also a better looking chart here. It was up 1.41%, but still below its 50-day moving average. And we're still seeing a leveling off here of the short-term correlation between US and world stocks, where the longer-term correlation is starting to get stronger, meaning that they're going in the same direction at the same time, whether that's up or down. Oil continues to be in the low 60s and was virtually unchanged. And the dollar is dropping a little bit further below 100 and just about getting ready to have a downtrend. That would be a death cross there. And we did drop down here with the 10-year yield after really going up quickly last week. We'll see if a further drop can give some more support to stocks. And we were also up with the 10-year based on price. And we're seeing some improvements, but not all that great with the growth to value ratios, the Qs to S&P still hanging out at its moving average. Actually saw a little bit of a decline with discretionary to the S&P and declining, but still above the moving average when we compare large cap growth to value. So the large caps are above their moving average, declining, but still above the moving average with the mid caps. And actually, from a growth versus value perspective, the small caps are looking a little bit stronger, but they're just not showing it at that's not showing up in the index itself. All right, so what's our outlook for Tuesday? The European Central Bank will be meeting on Thursday, and they're expected to make a 25 basis point cut or a quarter of a percent. And then the markets will be closed on Friday for Good Friday. And as far as our technicals, we are still negative in the short and intermediate term, where we're mixed in the long term. And then on Tuesday, we're going to get the Empire State Manufacturing. That mostly applies to New York. And we'll get import and export prices, which usually don't have that much of an impact. I don't know, because of the tariffs, maybe folks will be paying more attention to this. And then anything geopolitical, which right now it's more domestic as far as what's happening with the Trump administration. What are they changing? Is it causing upheaval? Does the market like it? Do they not like it? And so forth. And here is, excuse me. And then as far as the big report coming out this week, it'll be retail sales on Wednesday, and then we'll get industrial production and capacity utilization. We're keeping a really close eye on jobless claims to see is the employment situation holding up. There's another look at the economic calendar for the week. Seasonality, the market's been just not really sticking to any kind of seasonal pattern for right now, where we're neutral to positive with the Dow and we're just flat out positive with the S&P for April 15th, where we're neutral to negative with the Nasdaq. So it's going across the board here, and we are dealing with this being options expiration week, which tends to be up 67% of the time and then down 33% of the time. Seasonality, again, the solid lines are what has typically happened. The dashed line is what happens during a post-election year. We do see some positive seasonality for the next day or two here. So the warning signs, we are still negative but improving with our oscillators. Momentum is seeing signs of improvement, and we're actually looking better here with the bullish percent indexes. We've actually turned positive with the S&P, but they're still below 50. And I'll probably switch this over to the positive side here pretty quickly. The moving average studies, those are the ones that Bob Kendall says are useless. I think they're pretty useful. We're improving, but they're still negative. The ease of movement is improving but negative. The money flow improving but negative. The vortex is still negative. That's another primary indicator. That's why it's gold. And then our long-term special K chart, I usually only show that over the weekend because we don't get very many signals from that chart. It's still negative as well. But our smart money indicators are still hanging in there looking positive. We're still hanging on here a little bit to our growth to value ratio. I'm probably going to have to switch that over to the negative side here pretty quick. We're just not seeing that much of an improvement there. But we are positive with the S&P and NYSE McClellan oscillators and summation indexes. The parabolic SCR, new addition back to the positive side here. The Swelling trading oscillator is positive, and the ultimate oscillator just switched to positive. And the financial sector, it's slightly above its 200-day simple moving average. And the momentum for the NASDAQ 100 is starting to turn more positive as well. And then we have this mass index. We don't know if there's anything to this or not. It's just kind of one of those novelty charts that I use. It can work out really well, but it's like you don't want to use it all by itself. Okay, so our conclusion, we are negative in the short and intermediate term. We continue to be mixed in the long term. We are seeing some improvements in both the short and intermediate term, but we're still below the 200-day moving average in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.